just say thank you for making the time. Thank you to all our journalists from across Africa who have taken the time to be part of this program today. We are here today, of course, because of the leading global risk consultancy and specialists in that regard, control risks, and their partners, Oxford Economics Africa. They have organized this conference today to launch the 7th edition of the Africa Risk Reward Index. That's the report that they have been releasing for the last 6 editions. This is the 7th edition. So I'm not going to waste any much of your time. I will be part of this process and moderating and managing this process. And again, I just want to say a big thank you for the time that you have taken to be a part of this program. So please just allow me, if you can, to introduce you to the global team of specialists, African specialists who are the panelists for today's press conference, and they have extended experience in this regard. And many of you may know, some of you are joining us not for the first time. Obviously, you're joining us, maybe this is your second, maybe your third time, and you are familiar with the Africa Risk Reward Index, and you are familiar that this is it's an authority that players are using across the African continent to make decisions based off the risks that the African continent is facing. My name is Anea Piri. I'm a senior account manager with the APO Group. I will be moderating this session with you. So do please feel free to ask questions as and when the time comes. But allow me at this point to just introduce to you the global panel that's going to be there. Thank you. I just saw that somebody started the recording session. Thank you very much. We will be speaking today to high-level people who know about risks and rewards insofar as the African continent is concerned. The theme for this particular event is opportunity through uncertainty. So we might hear what some of us might think is bad news, but let's try and listen and let's try and see what the opportunities exist in that uncertainty. I will then introduce the team that's going to be part of this process. I'll be introducing Seamus Duggan, an associate director with the Sub-Saharan African Control Risks based in South Africa. Seamus, if you're there, you just say hello and if you can see and hear me clearly.
I am indeed. Good morning, everyone. Great to be here.
Welcome, Seamus. Thank you. I will also be introducing Patricia Rodriguez, who's also an associate director at the Control Risk based in Kenya. Patricia, are you with us today?
I am. Hello, everyone. Great to be here.
Good to have you. I'll be introducing as well Vincent Ruget, who's a director Africa at Control Risk based in London. Vincent, are you with us today?
Hi, good morning, Anea. Yes, I am.
Thank you. Thank you for being with us. There's a big funeral in London, but thank you for being with us this afternoon. I'll also be introducing Zainab Animashan, who's a senior analyst at Control Risk based in Nigeria. Zainab, are you there?
I am. Good morning, everyone. Pleasure to be here. Thanks for having me.
Thank you. Thank you for being with us. I'll also be introducing Jacques Snell, who's head of Africa Macro, NKC Africa Economics. Jacques, are you with us today?
I am. Hi all. Thanks, Anna.
Thank you. Thank you for being with us this afternoon. If you can just allow me very quickly before I do get to the speakers, I'm going to state a few house rules today. Again, we do appreciate extensively our friends from the media for being part of this process. But let's just get some house rules in play before we proceed. So the program will run for at least an hour, maybe a bit more. We will allow our speakers to give their insights and views on this year's report. Again, like I say, the theme for this year's report is opportunity through uncertainty. And they will unpack sort of the major themes featured in the report. And then we will follow this by 15 minutes of questions. Please let us know where you're coming from, your name. When you ask the questions in the Q&A feature, please just let us know your name. Our experts are very happy to answer these questions. Don't forget to mention your name and the media outlet that you're coming from. As anonymous questions, unfortunately, will not be entertained. We just want to be able to address the name and the outlet that you're coming from, if that's okay. At this point, if it's okay with everyone, without further ado, I will hand over now to the panelists, just so that they can get into the meat and the reason that we're here for. So I'm going to just now hand over to the panelists. Team, over to you.
Thank you so much. We also do have a few slides that will be showing as we're talking through the content of the report. So if we could have those up, that would be fantastic.
Absolutely. I do have a team that's going to provide that support. So Sandra and Tracy and team, if you could just, yeah, Sandra is just on the chair, there you go.
Great. Thank you so much, everyone. And just to introduce the report and what we're going to be talking about for the next few minutes. So this year's Africa Risk Reward Index really looks at what major African economies are going through at a time of increasing global uncertainty. So there's obviously the conflict in Ukraine, which has not only disrupted commodity supply chains, but also food supply chains. And on top of that, there is an ongoing energy transition, which is also affecting the way African economies are growing and having to adapt to this world. So this year's index essentially has this as a backdrop. And as we talk through the different themes, this is what we have at the back of our minds. If we could go to the next slide, please. So just for a bit of background, the Africa Risk Reward Index is a joint publication between Control Risks and our strategic partners, Oxford Economics Africa. Essentially what we try and do is our team of political risk analysts with Control Risk and our team of economists at Oxford Economics come together, we put our heads together and try and rank different African economies based on their risk and reward. So on the risk side, we're essentially looking at some political and institutional variables and indicators, whereas on the economic side, on the reward side, we're looking at some of the more economic related indicators. So every year we try and chart the evolution of some major African economies to see how they rank against one another. This again is in reflection to the global economic and political context that we're operating in, but also really trying to look at it from an African continental perspective. So this year, before I hand over to Jacques, some of the things that we have been charting include things like political stability on the risk side, and on the economic side, we'd be looking at economic potential. I'm just going to hand over briefly to Jacques to talk us through some of the methodology and the big movers this year. And then we shall talk through the three different themes that we have identified as being the most relevant for African economies in the coming year. So Jacques, over to you, if you can talk us through some of the methodology and findings.
Thanks, Patricia. All right, so just to unpack the methodology a bit more. So the first dimension we look at is risk. So here we look at a series of political and economic risk factors. In the economic side, we're looking at things like exchange rate risk, market demand risk, which measures the risk that market demand in that domestic economy slumps for some reason, market cost risk, which looks at the cost of doing business in that country, sovereign credit and trade risk. And then on the politics side, we're looking at social cohesion, international relations, security and business environment, ideology and policy, and then just broader political stability in that country. So these risks are then each assigned a weight based on the potential impact that this risk has on business in that country. And then we get an overall risk score for that country for that year. On the other side, or the other dimension we look at is the reward score. So here we're looking at the country's medium-term economic growth prospects, We also incorporate the size of the economy, economic structure, and also incorporate some demographics in there. So economic growth has the biggest weight because investment opportunities, of course, multiply when growth is really strong in a country. But of course, the absolute size of the economy matters, the structure of the economy matters, and the demographics are then incorporated through the formulation of what we call the demographic dividend. So this incorporates the population size and the outlook for population size, urbanization levels, and age dependency ratios in that country. So a quick look at this year's findings. The top improvers this year were Angola, Cote d'Ivoire, Senegal, Mozambique, and DRC. In Angola, we saw a slight reduction in risk, which is positive again, but there we saw a notable improvement in Angola's reward score. The policy environment there continues to show signs of improvement. President Lorenzo has set out a clear policy direction aimed at diversifying the economy away from oil. And this is, of course, very beneficial in the country's ability to attract the all-important foreign investment. Also on the economic side, after 5 consecutive annual contractions, the Angolan economy expanded last year, and we expected to record moderate growth in coming years. So this transition from a string of annual GDP contractions to a positive economic outlook had, of course, had a positive impact on that country's reward score in the latest publication. In Cote d'Ivoire, we saw a slight reduction in reward score, which is negative, but there we saw a notable gain on the risk front. There we saw President Ouattara has done a lot to lower tensions between the government and the opposition, and it's encouraging to see this reconciliation between political adversaries. President Ouattara also appointed a vice president who is a very business-friendly figure, which is, of course, great for the country's reward prospects or reduces the risk of operating in that country. Finally, Senegal, again, it's an economic story. The country is expected to commence gas exports next year, which has the potential to completely transform the economy. Just taking a step back and looking at the overall performances, the highest reward scores are found in Ethiopia, Nigeria, and Egypt, as we can see on this chart here. All 3 of these countries benefit from favorable demographics. Egypt and Nigeria benefit from their economic size, while Ethiopia and Egypt both have pretty decent growth prospects. But again, as we can see from the chart here, Ethiopia and Nigeria in particular also have very unfavorable risk scores. So in Ethiopia, we've got the ongoing conflict there, and also the country is also struggling with some weak macro fundamentals. In Nigeria, there's the country's oil dependence, which remains a concern, and there's some deep structural issues surrounding inflation and unemployment. So I would like to hand over back to Patricia now to just introduce the themes we discussed in this year's report.
Thank you so much. So accompanying this index, each year we try and identify which key issues are going to shape the trajectory of various African economies. This year we have identified 3 themes as usual. So the first is around the global energy transition. The second is around Africa's unhealthy dependence on external food supplies. And the final one is more of a political, perhaps a little bit more of a pessimistic theme, talking about how different African economies and their leaders are responding to rising public discontent. So to talk us through this first theme, I'm going to hand over to Seamus, who's going to give us his thoughts about the energy transition, especially perhaps from a South African perspective. Seamus, over to you.
Well, thank you very much, Patricia, and good morning and good afternoon, everyone. So as Patricia was giving the overview there, some of you may have picked up that I'm lucky enough, I think, to talk through one of the themes that is more optimistic, where we see quite a lot of reward and opportunity in the future. And ultimately, I think a win-win situation for African governments, for investors, although maybe not as much for consumers on the continent and elsewhere. Now, I suppose for context, you know, for many years now, we've been talking about a green energy transition. and to move away from fossil fuels. In Africa, there's been a call sort of on the side of this for what we'd call a just energy transition, which is to move more slowly through the fossil fuel sector into the green economy over time. And of course, in the last year or so, things have probably been made a little bit more complex by events in Ukraine, with Europe facing a lot of sort of gas shortages over the coming year, we expect. But where Europe is seeing, I think, risk and challenges, in Africa, we see the potential for reward here. And in fact, despite these global calls to decarbonize the energy economy, and despite, I think, an increasing chorus of global players who are shunning fossil fuels, in Africa, we are actually seeing renewed interest in these fossil fuels, in oil, in gas, and actually, I think, in gas in particular. So if you look at some of the countries and some of the activities that are going on at the moment, in Tanzania, for example, a long-stalled liquefied natural gas project is beginning to pick up steam and attract new attention. In northern Mozambique, which has had some security issues in recent years, we're starting to see more stability, and hopefully on the back of that, a kind of resumption of activities up there. And we're also seeing, I think, as demand for oil and gas increases, we're seeing opportunities and dynamics in the region that are lending themselves to greater cooperation. So if you look in West Africa, Senegal and Mauritania's joint oil and gas project is expected to reach production next year, in 2023. And that's because it's receiving additional impetus from oil and gas shortages in Europe. Meanwhile, if you look at places like Niger, Nigeria, and Algeria, they recently signed a memorandum of understanding to build a trans-Saharan gas pipeline. So again, there we are seeing increasing activity. Now, I think it's fair to say that while we see investment going into the oil and gas sector, as well as into sort of hydrocarbons generally, that is coming or proving frustrating to certain sort of local, global, regional environmentalist groups who see current energy dynamics as an opportunity for Africa to sidestep fossil fuels entirely and invest in renewable or green energy sources. And I think it's pretty easy to understand why. Africa, of course, has huge opportunities in solar power, in wind power, in water power even, and a huge sort of untapped potential, not just for investors looking to produce at a macro scale, but in terms of pushing the electricity grid into rural areas and making sure that everyone has access to electricity. I think, on the back of that, despite this debate that's going on between, how African governments are going to approach energy, one way or the other, we see revenues coming in, much needed revenues on the back of the global COVID-19 pandemic, which has, of course, hurt many African states who are already under strain on the back of earlier financial crises over the last 10 to 20 years. So it's going to be, I think, whether they pursue a path of just transition or a more aggressive green transition, many of these states are going to be benefiting. So this is why I think we see it as a win-win situation. I think just to finish off briefly, what I would say is, while there's a lot of positive things to say about the energy sector and where it's going, we do, of course, expect that any investors into that sector are going to face challenges. They are going to face complexities, particularly when we look at environmental regulations and legislation, as well as social community issues and governance more generally. Lead times, we of course have always had issues around corruption, around securing permits, around working with local communities. And those specific local contexts will of course prove challenging, although ultimately we believe rewarding. Thank you very much, Patricia.
Thank you, Seamus. If we can go to the next theme, which is really a bit of a mixed bag, to be honest. So in this theme, we're exploring Africa's dependence on external supplies for a lot of its food staples, What has come to the fore in recent months, especially with the conflict in Ukraine, as well as emerging climate disasters elsewhere in the world, is that most African countries are still net importers of some really critical food supplies. So in this theme, we're trying to explore whether or not the answer to this food security issue on the African continent can actually be found within the African continent. We identify essentially two main issues that are currently preventing Africa from being food secure. The first one being a reliance on smallholder farmers, while there's a large and growing population. So this means that the current food production is not really able to keep up the pace or to serve entire population. Then the second thing that we've highlighted is that some of the most productive areas, some of the countries that are gaining most from their food sectors are focusing on very high value crops, but these are not necessarily food staples. So we're talking about things like coffee and cocoa, for example. So in this context, we take a look a little bit forward into the future, trying to see whether things around regional integration, and in particular, the Africa Continental Free Trade Agreement, can actually offer a solution to this food security conundrum. So there's been a shift among African governments about the need to be able to trade with one another, and actually to do that in a profitable manner. So in this article, we actually highlight how perhaps the problem of importing food from as far away as Europe can actually be solved by African countries trading a little bit more with one another. We do want to highlight that this is a more forward-looking theme. You know, the solutions to Africa's food security are not going to come immediately, and certainly not in the short term. There still has to be a huge amount of investment, both private and public, dedicated to things such as basic infrastructure, including transport and energy, because as it stands, a lot of the infrastructure is oriented toward exporting outside of the African continent, as opposed to trading with one another. But as with all the other themes, we also do try and look for the opportunity. There will be emerging opportunities for lots of different companies, not just those involved in food production, but especially those involved in issues such as agricultural manufacturing, in logistics, and more broadly, sectors such as real estate. So if I was to summarize the theme, it would be essentially African countries have found themselves with this reliance on external sources for their food staples. And this is now prompting a rethink around whether or not the African continent needs to trade more with each other, and how exactly they'd go about doing that. The good news story is that there is global initiative and momentum to actually invest in Africa's agricultural sector, as well as its logistic sector. So while it might seem a little bit gloom and doom at the moment for the food security issue, we do think that the food sector more broadly will have an abundance of opportunities for investors. And now is a really critical time to do that, because if I can hand over to Jacques now, food insecurity is costing governments a lot of money at a time when they can ill afford it. So Jacques, if you wanted to talk us through perhaps the economic impact of food insecurity.
Sure, thanks, Patricia. Yes, I'd just like to sort of discuss the interesting macroeconomic dynamics surrounding food insecurity. So firstly, Africa imports around double the amount of fruit, vegetable, and grains that it exports. So the structural merchandise trade deficit of essential goods, such as foodstuffs, has some pretty noteworthy macro implications. Firstly, these countries are susceptible to fluctuations in international food prices, and we saw this, or we're seeing this most starkly this year. And currency fluctuations then also have an impact on domestic food prices. So currently currency weakness can stem from factors completely unrelated to food prices. So these include like political developments or commodity price fluctuations other than food prices that are very important for that specific country. So this currency weakness, because of this food independent or dependence, then increases domestic food prices. And the inflationary implications of this are very important here, because in advanced economies, food typically accounts for around 15% of the CPI basket, but this figure exceeds 25% for most African countries and is above 50% in Ethiopia, Zambia, Sudan, and Nigeria. So the point here is that food prices are more volatile in Africa and have a disproportionate impact on inflation readings on the continent. But here I would like to emphasize the second round effects of more volatile food prices. So firstly, tighter monetary policy in an attempt to manage inflation then has broader macroeconomic implications. As you know, higher borrowing cost isn't good for business. And also importantly, inflation expectations also matter, because these feed into wage negotiations, and this then has the potential to sort of entrench higher inflation in that country. And we know that higher inflation disproportionately affects the economically insecure in that country. I'd like to hand over to Zainab now to discuss our final theme.
Many thanks, Jack. Good morning, everyone, again. So diving right into the third theme, what we looked at under this theme really is the rising wave of anti-government sentiments that we're seeing across the continent, most of which have been triggered by two things. So the exponential rise in living costs over the last year that we've seen, and then also growing frustrations by citizens with the slower than expected responses by governments to these economic challenges. Now, we looked at this theme from two broad perspectives. So we looked at it from the government's angle, and what we found were a majority, of these countries struggling, like many other countries across the world, to respond to the sustained economic shocks from the COVID pandemic and the ongoing Ukraine conflict. And these shocks, we found, really created a new set of challenges for African countries. So most of them are also struggling along with their responses to those shocks with mounting public debt, some of which was incurred before COVID, and others during COVID, just expenditure to keep the country going during the lockdowns. And in addition to that, a lot of them have revenue constraints as a result of the, lower production levels that they saw and expensive imports. And I think I'll have Jack talk about that in more details shortly after I'm done. From the citizens' perspective, we also looked at the fact that, most citizens are now on the receiving end of unexpected hikes in food prices, consumer prices. You're seeing hikes in food staples, fertilizers, fuel, and this has also been reflected in the rising cost of in record highs in inflation rates, which is what Jack just mentioned. And so you're seeing highs in countries like Zimbabwe, Ghana, and Nigeria. What ARRI really explores, in fact, are three broad trends. So we saw, in response to the rising cost of living crisis, we saw protests happening across the continent. So in countries like Ghana, Sierra Leone, and South Africa, we're seeing quite a number of cost of living protests persistent over the last 1 year in response to that. We're also seeing higher rates of youth participation in electoral processes, just trying to look for ways to sort of replace the veteran political elites that we're seeing with younger politicians, I guess in a way to sort of control the narrative of how their countries are being managed and their economies. So in countries like Kenya, we just saw the recently concluded elections where a younger former Vice President William Ruto came in over, a very well-known veteran. In Nigeria, we're seeing that happening also, where we have a third force candidate, Peter Obi, also being considered as, a populist candidate, much younger than the established veterans that we're seeing. The third thing that we're seeing, which is a more disturbing trend, are military interventions across the region. So we're seeing younger military officials coming in to take over and intervene in certain countries backed by populist support. We've seen that in countries like Mali, Guinea, and Burkina Faso over the year. But the outlook really from the ARRI report really is that these trends are not likely to produce the expected political outcomes that the citizens might expect, mostly because most of these governments simply do not have the capacity to address these challenges that their countries are facing. It's really above them currently, based on the data that we're seeing. Secondly, the government's responses to public dissent is becoming increasingly violent in some of these countries, and that's creating further political instability and security risks in most of these countries. And in addition to that, most of these military interventions are just attracting more and more economic sanctions from regional and international communities and blocs like the ECOWAS, the AU, and the United Nations. And this would probably make it much more difficult to operate in most of these countries. And so what this thing really says to businesses and investors looking into these countries really is just to understand what's going on right now, what's driving these challenges, and prepare ahead for the risk, because it looks like it's going to be a long haul situation, and look for ways to just be, avoid being indirectly or directly targeted as a result of these challenges that we're seeing across the continent. But I'll have Jack just look through the data and related findings in our ARRI report and just talk through what's really driving this particular theme. Jack?
Thanks, Zainab. Yeah, so just to put some figures on these fiscal positions, at the moment, the IMF considers roughly half of countries in sub-Saharan Africa to be in debt distress or at high risk of debt distress. So as we've mentioned, the COVID-19 pandemic really exacerbated some unfavorable fiscal trends that were there before the pandemic, but in some cases, the pandemic just sort of pushed these fiscuses over the edge last year. To put some figures on that, public debt is expected to exceed 100% of GDP in Egypt and Morocco this year, and to exceed 70% of GDP, which is still very, very high, in Kenya, Ghana, and South Africa this year. But I think more importantly is to look at debt affordability. And for that, we like to look at the debt interest payments as a proportion of fiscal revenue. So this sort of then gives an idea of a government's capacity for discretionary spending. And looking at this ratio, it's nearly 60% in Ghana, meaning nearly 60% of Ghanaian fiscal revenue will be directed towards debt repayments this year. In Egypt, this figure is just over half of revenue. And in Nigeria, 1/3 of fiscal revenue will be directed towards debt servicing. And that's despite Nigeria having much lower debt figures than most other countries in Africa, which is just a reflection of how expensive Nigerian debt is at the moment. For international comparison, this figure is around 10% in countries like the US and UK. So considering the size of other sticky expenditure items such as wages and salaries, there's actually very little scope for these governments to redirect spending to provide economic support without accruing additional debt. And at the moment, it's really a bad time to go into debt markets looking for additional debt. Appetite for local currency debt is souring, and that's due to high inflation and exchange rate risk. And external debt costs have also surged, and that's due to tighter monetary conditions in advanced economies and, of course, increased risk aversion. So, on the one hand, this could accelerate fiscal consolidation efforts, which would mean cutting short any economic support measures, which would then further exacerbate growing civil discontent. Alternatively, governments can redirect spending, which tends to mean that investment spending drops, which is of course not good for medium or long-term growth prospects. But perhaps even less favorable outcome would be if governments are unfazed by rising borrowing costs and just continue down this unsustainable fiscal path, which would require much deeper and more painful fiscal consolidation in a few years' time. So on that rather somber note, I would like to hand over back to Ene to talk us through the Q&A session.
Thank you. Thank you very much, Jack. And thank you, team. At this point, I will just open the floor for questions. I know we've got a couple already, and we are going to segment the questions by theme. Any questions related to energy, Seamus is going to take those. Any questions related to sort of supply and food security? Patricia is more than capable. And questions relating to government response and discontent. Zainab is going to take those, and Jack at Oxford Economics is going to take any questions relating to the index scoring. We've got a couple of questions already. It's just that we don't have. I know, but Charles hasn't mentioned where he's from at this point. So I'm just gonna sit back and wait if we have any other questions. We've got Samuel, you didn't finish your questioning. Samuel Uma, you didn't finish your questions. Please, if you can proceed with your questioning so that our more than capable team can come. We have a question here coming in from Nigeria, if that's okay. Edwin, publisher of Omega News in Nigeria. His question is as follows, team. He says, for the African economies to move from her over independence on import, I think it's over dependence, we would need to be able to solve the energy challenge. Availability of energy has been a problem, and even when availability is nearly unaffordable, so SMEs do struggle. How can, I think this is where the question comes in, how can African nations effectively address the energy problem so as to boost production and move us from consumer economy to producing and exporting economy? That's an energy question coming to us. So I think Seamus, if you can take us through the response for that.
Yeah, thanks very much. I suppose the simple answer to that is greater cooperation between African states. And not just, I'm not just talking about in terms of, sharing assets or building infrastructure. I think if you look at, where energy products ultimately go, it's often to Asia or Europe or North America, and less so within the continent itself. And often that's because of a variety of reasons, from bureaucracy through to demand. So if we saw greater cooperation through, for example, the African Free Trade Area, which is coming on quite nicely over time, I think that would help to resolve that supply-demand problem on the continent itself.
Seamus, thank you very much. Edwin, I'm not sure if that satisfies your question. Let us know if you have a follow-up question in the Q&A forum. Again, team, if you want to ask a question, just please go into the Q&A forum. Tell us who you are, where you're coming from, and we'll be very happy, more than happy to respond to your question. I've got a couple more questions here. Samuel, thank you very much for for just coming back with us. Samuel Uma from Pan-African Visions, Nairobi. His question is as follows. Do you think the upcoming African Energy Week slated for next month will be a game changer in the energy sector? I think, Seamus, you're on the spot again. That's for you. What are your thoughts on the upcoming Energy Week slated for next month?
Well, we'll have to see. But no, I think more seriously, it's obviously coming at a time, a fairly critical time insofar as we are seeing, as I said, a shortage of gas globally, particularly sort of going to Europe. But at the same time, we're seeing Africa has the resources to exploit and to produce, and there is this new impetus to kind of invest in Africa. So, at these sorts of events, we would expect to see, and I think particularly this year, a lot more activity. And also remember, for the last 2 or 3 years, we've had restrictions on movement because of COVID-19. Earlier this year, we had the African Mining Indaba in Cape Town, for example. It was the first one in a couple of years. It was very well attended. There was a lot of energy, a lot of kind of desire, both by governments who attended en masse and by investors. And I believe we'll see the same thing at Africa Energy Week this next month. So I think, yes, I think it's going to be a positive story.
Seamus, thank you very much. Certainly, I mean, so many good insights. I was just being in Zambia myself. I was just thinking through what Patricia had mentioned. I think Zainab had also mentioned about, the transfer of power from the older to the younger generation. It did, in fact, happen as well in Zambia. So this is something that we are truly experiencing on the African continent. We do have a couple more questions, and if I could just get down to them, if that's fine. We do have Fred Ndugu from Kenya. And his question is, we are yet to know of the new government's agricultural policy. He's speaking particularly from Kenya. He says, in Kenya, we're yet to know of the new government's agricultural policy, but we're still in drought conditions. And it looks grim without water, even for irrigating. Any tips for better policies? That's coming from Fred. So I think that's Patricia, that one's for you from a supply and food security, for supply chain and food security point of view. Any tips?
Sure. So on the agricultural policy of the incoming president in Kenya, he's been very vocal on wanting to have better support for the agricultural sector. Unfortunately, as we have already mentioned, Kenya is one of those countries where the public external debt levels are quite high. So being able to coherently fund any kind of agricultural policy is going to be quite difficult for the incoming president. You may know they've already had encountered some difficulties in sustaining some of the subsidies on fuel. The fertilizer subsidies are still in place, but there's a few question marks exactly on how the Kenyan government intends to fund those. On the policy front, because the Kenyan government in particular is quite constrained economically, unfortunately, as you've mentioned, in the middle of a drought, the emergency response is likely to take precedence. And so there will be a huge amount of reliance on external sources, and that's both for emergency food supplies as well as emergency interventions such as fertilizer subsidies. So the Kenyan government is going to have to, I suppose, play nice with everyone to make sure that they get both the financial resources that they need, as well as that kind of emergency humanitarian response. But the overall policy outlook, I would say, for the agricultural sector may be a bit more positive under the incoming president, because he has made a concerted effort to appeal to farmers in the agricultural sector more broadly in Kenya. So the short answer is we'll wait and see, but the Kenyan government is going to be quite constrained economically to be able to respond as well as it would like.
Patricia, thank you very much. I hope that does answer your question. Please, if you have any follow-up questions, Fred, please type them in the Q&A. I did miss a question from Naftali Mwaura from Xenia News in news agency in Nairobi, Kenya. And this question is to you, Patricia, so you're on the spot still. Please list the most outstanding risks facing Africa's economies for now and possible remedies. These are some tough questions coming at you, team. If you can, Patricia, please.
Sure. So I think I would put them into two broad buckets. One is on the political side, and then I'll ask Jacques to comment on the economic side. So on the political side, as we've heard from Zainab talking us through the theme, there's still a huge amount of instability, which is unnerving some investors. So we're talking about, these various pockets of conflict across the continent. There are political transitions, including elections, but also military interventions. So political instability would probably be number one on that kind of risk list. The second one, which all of us have touched on as we were talking through the themes, is the regulatory environment. While African governments are quite keen to attract foreign investment, it can be quite difficult to actually operationalize your investment on the African continent because of opacities in the regulatory environment and long-standing issues such as corruption. So the institutional environment may not always be the easiest to operate in. And as a final point, we would just highlight not just that Africa is not a country. There will be different differences in the environment depending on where you go. And I think navigating those differences in and of itself is actually quite challenging. So while people might be familiar with operating in South Africa, for example, if you're moving up north to countries in North Africa, the institutional and social cultural environment might be quite a challenge to navigate as well. So on the politics side, just to summarize, we still see quite a lot of instability and inconsistencies in the regulatory environment, which can be quite a challenge for investors to navigate. Jacques, I don't know if you want to comment on the economic side of things.
Yes, but to sort of make the same point that, as you say, Africa is not a country, so there will be some overarching issues that most countries in the continent face, but at the end of the day, it's those specific country obstacles that are hindering investment in a specific country. And that's why it's so important to sort of get a grip of what's exactly going on in that country. How does that compare to another country in that specific industry? So to answer that question, I think it's really country specific, but as Patricia said, there are some overarching themes. And I think the economic side of the coin that Patricia just described is that you need that stable environment for long-term investment. And long-term investment is the sort of stuff that Africa really needs. The energy infrastructure, like the one question suggested, that's one of the continent's most pressing issues, is the lack of electricity. And then also related to the Kenya question, the lack of water infrastructure is one of the main reasons why the continent is so prone to droughts. So to get the environment in order for those long-term infrastructure investments is going to require political stability for extended periods, and then the institutions, the economic institutions and policy framework that are then going to encourage this longer-term investment.
Team, thank you very much. I know our very respectable friends from the media are following with the responses, so please do ask if your question has been responded to adequately. If not, again, happy to have the team respond. We do have a question for Zainab. This question is from E. Chike Njoku, and they ask, it appears Ghana's heightened risks and lowered reward scores are largely economic induced. Considering the prevailing global economic conditions and recent warnings by the World Bank of a global recession in 2023, is there any possibility of reversing the trend in Ghana? What should policymakers be doing? This is again from Ebenezer and Njoku, B and FT Accra. I've just asked that question again. This is for you, Zainab. It appears Ghana's heightened risk and lowered reward scores are largely economic induced. Considering the prevailing global economic conditions and recent warnings by the World Bank of a global recession 2023, is there any possibility of reversing the trend in Ghana? What should policymakers be doing? This is coming from Accra. Thank you so much, Ebenezer, for your question. Zainab, over to you.
Thanks, Sinaya. Thanks, Ebenezer, for that question. You are right. The issue that Ghana is facing right now is economically induced. This was a country that, as of 2018, 2019, the IMF considered it to be the fastest growing economy in the world. And unfortunately, COVID happened, production slowed down, exports slowed down of their key commodities, and afterwards, the Russia-Ukraine conflict came in and sort of disrupted, supply chains into the country, which is very heavily import reliant. For example, on Ukraine, it imports, wheat, almost 60 to 70% of steel, wheat, and other products from Ukraine. And so most of the challenges that it's had really are a result of bad timing and just, the economy not being what it is. And in addition to that, like I mentioned, covering that theme, there was also a lot of debts that the country had incurred over the years. I think President Nana Akufo-Addo and his economic team, led by the Minister of Finance, are currently trying to respond to the challenges. It's obviously, from a political perspective, having the kind of parliament that they have, and the concerns that both of the key political parties have around the way the government is addressing the issues is also part of what is slowing down the response to the economic challenges. But I think the government is currently trying its best to move forward with what it has. It has approached the IMF, and it is trying to see if it can get enough support to pull out of the challenges that it has. It's currently on the right track, like I said. What the policymakers can do is probably just try as much as possible to come together, both the NDC and the NPP, to probably agree on what the best approach is to addressing the economic challenges, and take that forward from there. I don't know if Jack has anything from a data perspective to add in terms of what Ghana is going through right now and ways in which it can be addressed.
Yes, Ghana has been, or the Ghanaian government have been making pretty difficult decisions at a pretty difficult time. If you think of the very unpopular e-levy that they put in place and are keeping in place, and that's of course to shore up the fiscal position a bit, and the pretty staggering monetary tightening that the central bank there has also implemented. So it shows that the government's not shying away from making the difficult decisions. A lot of these decisions are, of course, in an attempt to sort of get the IMF on board, which is going to be very important at the moment where, to be honest, Ghana isn't able to get funding at anything close to affordable externally. And it's also not going to work to just, soak up more domestic financial resources. So the government does look like it's making hard decisions, but as we've seen, the people aren't too happy there. We've seen a lot of increase in protests there. And like Zainab said, they are on the right track. If they get the IMF on board, if they can sort of just ride the current headwinds out and get everybody to buy in, and that they're making the right decision for the country's medium-term growth, then things could improve in Ghana.
Thank you so much, team. We're not out of the woods yet, not by any chance. We have several questions. I think this is a testament of how impactful that this year's report is, as has been in the last few editions. So we do have a question coming in from Michael Uma, and I do have some questions in my inbox from our team in DRC, which I'm going to ask in a moment. So Michael Uma is coming from nettech.com, a tech and business news website. And his question is as follows: what are the trends as relates to illicit financial flows? I think this is a big thing in Africa, to the continent, mainly via digital channels, and how big an issue is this according to your analysis? So this is now from an initial financial flows point of view. Jack from Oxford Economics or the rest of the team from Control Risks, please respond to that if you can.
Okay, I'll take a swing at it first. By its very definition, illicit financial flows are very hard to sort of measure and come to terms with. But just going on the controversy surrounding South Africa potentially, and it looks likely being grey listed as one of the countries where illicit financial flows and terrorist financing is a concern, does show that it is a concern if that happens in Africa's most developed economy, so to speak. So it is a problem. Clearly in South Africa, it's now clearly a problem, but it's hard to sort of gauge to what extent it is a problem in other African countries relative to what problem it is in known offshore tax holiday destinations, if that's really an issue relative to the Cayman Islands, where it's more legal to do it there, but at the end of the day, the outcome's sort of the same. That's all I can say about that.
Jack, thank you very much. Unless the team wants to take a crack at that. This will be our last question, just before we close, if that's okay. Does any other member of the team want to take a crack at that before we close the session? All right. I want to say a big thank you to the team, both at Oxford Economics Africa and as well as at Control Risks. This is really an insightful report, and certainly we've learned quite a bit. I'm sitting in Zambia and myself just listening to it and seeing the work that's gone into it is definitely something that's worth looking at. I know our friends from the media are quite thirsty, and I think we have, in fact, whet their appetites for this particular one. I am sharing now on the screen just a bit more about who we are, Control Risks, and also who the Oxford Economics Africa is. So friends from the media, please do have a look at that. It doesn't end here. Not by any means. Please reach out to the APO team. We've got Sandra, we've got Tracy on the call. Should you have any sort of questions, if you have any interview requests, I can imagine just by the volume of questions, I know that our friends from the media do have several questions that they want to ask, and we are certainly here to support and to give you more information. So I just want to say a big thank you, first and foremost, to the team from Control Risks, as well as from Oxford Economics Africa, for taking the time. The work that you have put into this report is truly phenomenal, and it does give an idea, at least the context of where we're going as an African continent. But if you do have sort of any other questions, we are very happy to address these questions that we couldn't get round to on this particular call. Of course, we do appreciate that it's a short time, but we're very happy to address any questions beyond this particular call. So I want to thank you as well, our friends from the media. This is truly valuable of your time to be on this call, to ask as many questions and to seek clarity. Again, if we're thinking on the African continent, we are really thinking about opportunity through the uncertainty. So certainly thank you for coming out guns blazing, as they say, and asking very pertinent questions to the report that's been shared today. I think from the APO group, again, it's just a big round of thanks. Thank you to the rest of the team. It's my face that you see, but certainly there's a whole team behind this that's put this together. I want to again say thanks to the team from Control Risks. I want to say a big thank you to each and every one. Patricia, I want to say thank you to you. Patricia Rodriguez, I want to say thank you to you for your time and also for your effort. Seamus, I want to say thank you to you as well. Zainab, I want to say thank you to you. And also I want to say a big thank you to Jacques now from Oxford Economics Africa. Thank you for the time, and truly thank you for your insights.